All right, so the Feds just released a new statement. We got to get a video on this. When we shooting this video? What? Now?
Hey guys, Eli here, and the Federal Reserve just announced a major strategy shift Thursday that will likely keep interest rates low for longer to let prices go up and at the same time for jobs to flourish. So what does that really mean for the average American? And what can we do to actually take advantage of this situation and to make sure that we don't lose money in the process? Let's find out. So if this is your first time on this channel and you guys like to talk about personal finances and mindset, make sure you guys start now by hitting the subscribe button, leaving a thumbs up, and also comment down your thoughts in the comments below. And while you're at it, if you guys want a free stock on Robinhood or some books I believe you guys should read, or if you guys want to know what kind of accessories that I use when I'm making my production videos, check down the description below. So I'm going to read from this article, and when I'm done, I'm going to give you guys my opinion and let you guys know what can we do to actually take advantage of this. After an 18-month review, the Feds announced a long-term strategy that's designed to help central bank meet long inflation goals. The new strategy unexpectedly laid out in details a speech by Fed Jerome Powell declares that the central bank will now seek to achieve inflation that average 2% over time. That means after a long period of low inflation, such as the dozen of years following the Great Recession, the Feds will allow inflation to run hot by climbing above 2%. The Feds is once again signaling that it won't be in a rush to lift interest rates off the basement, even if inflation starts to pick up as the United States recovers from the pandemic. So what does this mean? I actually got an example for you. So from the Great Recession down in 2007 all the way up to 2020, we averaged about we wanted to hit 2% each and every year. All right, that was the Fed's goal from the Great Recession 2007 all the way to 2020. Even though the Feds wanted 2% inflation each and every year, some years they got 3 and some years they got 1. A lot of the years they got a little bit under 2%. So what they're saying is from 2021 all the way to whenever they see fit, let's just say 2030. It doesn't matter what the inflation is for that year, as long as by the time they're all done with this, it averages out to 2%. So another example is, let's say this box right here. If we're trying to get from point A all the way to point C, in this example, what we've been doing is we've been going outside the box where you see one year we have 1% inflation, then the next year we may have 3, then the next year we have 1, and the year after that we have another 1, and another 1 for a couple more years, and let's just say the last year we have 4. What that did was that average from point A to point C, we averaged about 2%. Now what the Feds want to do right now is actually go through the box, not really the box, but in this example, let's just say they want to go through the box. They don't want to go to point B, they just want to go from point A to point C. Which means one year we can have 5% inflation, the next year we can have 3% inflation, but as long as by the end of the year of whenever they're finished, let's just say all the way from 2007 all the way to 2030, as long as they average 2% inflation. Now, I really don't know if I hit a home run with that example, but hopefully you guys get a gist of what I'm saying. So what are my thoughts? The first thing I thought about is savers are really losers in this situation. Saving money would be the worst thing to do in a scenario like this. Reason being is because inflation is going to eat your money up. You can save it whether it be under the mattress. You can save your money at the bank, but the banks are only offering a 0.0002% return on your money. You won't have a chance, but you have some sort of a fighting tool. It's like bringing a knife to a bazooka fight. But the Feds don't mind letting inflation run wild, which means all the money you're saving, you may lose 2% this year, next year you may lose 5%, and the next year after that you may lose 3%. So right now, I really feel in the long run, you're really losing out if you're just saving your money. And that brings me to my next point. I do believe that the game are rigged for investors. Now, let's just think about it this way. Bank of America, they give you a 0.002, around there, percent return on your money. But you can buy Bank of America stock, which gives you a 2 or 3% return on your money. And you can keep your money there and take the chance of the stock prices going up. And on top of that, you get 3% dividend yield each and every year. Now, to be honest with you, that would be risky within itself, but it's just the chance you have to take. I mean, you could take the chances you're saving your money and then you're guaranteed to lose about 2 to 3, may possibly even more. Let's just say like this, you would lose an average of 2% whenever this whole thing is done, whenever this whole thing calms down and the Fed says, hey, you know what, we'll raise interest rates again. You're guaranteed to lose an average of 2% over time. Now, the second thought I have is the prices of everything is gonna go up. Now we all know if inflation's eating up the dollar, it's gonna take more dollars to buy whatever it is that you may want to buy in the future. So if you like to buy a $5 cup of coffee at Starbucks, you should expect 5 years from now it'll cost you
$5.50.
possibly even more to buy that same cup of coffee that would cost you $5 now. Which brings me to my third thought. Now, I do believe asset is true wealth. Asset is true wealth. You can have all your wealth stored up in cash and then it's just nothing but a piece of paper and then it loses value over time. Or you can have assets which is known to appreciate over time. Now, assets do appreciate due to inflation and also demand. If there's a high demand for that asset, then the prices are gonna go up. So instead of holding cash, why don't you hold on to assets, whether it be stock market, real estate, precious metals? Assets such as those has historically shown that the prices has always gone up through the test of time, while the prices of the dollar has always gone down. And the fourth thing that ran through my mind when I was reading this article was, this is exactly what the feds want. I mean, the more inflation, they welcome it. The US accumulated a huge amount of debt within the past couple of years. And to be honest with you, the more inflation goes up, the less and less that debt actually becomes. Let's just put it like this. If I borrow $1,000 from you today and I just decide to say, hey, you know what? Hey, thank you for that $1,000, but I'm going to pay you 30 years later. And the fact that inflation is going to happen within the next 30 years, that $1,000 is actually cheaper for me to pay off 30 years from now. So if the government's in trillions of dollars in debt, then 30 years from now, it may be less than that and they could probably easily pay it off, or it'd be easier to pay it off for them. So that's why I believe that the government do want this to happen. Now, how do we take advantage of this? We know if we're saving our money, we're gonna be losing money, whether it be in a bank account, we're gonna be losing our money regardless. Now, how do we take advantage of this? We know due to inflation that the prices of assets are gonna go up. So the best thing to do is invest in assets, whether it be precious metals. Throughout the test of time, it's shown that the prices has always gone up. If you look for the long term, of course, we can invest in real estate. You can buy a house, and we all know. We all have that one grandma that says, hey, you know what? Back in my day, I bought a house for $30,000. And right now it's $300,000. Maybe 30, 60 years from now, I may be telling my great grandson, hey, you know what? I remember when I bought a house for $300,000 and now it costs $2 million. And another asset class to invest in is the stock market. If it costs $100 for a share of Apple today, and 10 years from now, with inflation, let's just say we accumulated an average of 2% for the next 10 years, as long as the core value of that Apple stock is still there, more likely the price of that Apple stock will rise with the price of inflation. So in all totality, we have two options. We can either save our money and let it get eaten up by inflation, or we could take a chance and risk and put our money into assets. And hopefully, if the right research has been done, your assets can appreciate. But I'm not a financial advisor. I always tell you guys to always do your own research. Don't just follow a random stranger on YouTube. But that's pretty much all I have for you guys today. I want to know what you guys think. Comment down below. And don't forget to hit that thumbs up button. It's highly appreciated. And also subscribe to the channel if you haven't already. And also check out some of my other content. Thank you guys so much for watching and have a beautiful day.